And we're live.
I think we're live. It's hard to tell. It says it's still setting up your meeting for YouTube Live, so I guess it'll let me know at any moment now. In any case, that's
Just go.
it's Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Jason Hirschman, Hudson
Hudson 215
215
Capital.
215 Capital. Thank you.
215 Capital.
Jason, welcome. It's good. You and I've become friends over the last couple of years, so it's exciting to have you on the show.
No, it's really appreciate being here on the show and really excited to talk about what's going on out there.
Jason,
So maybe
you're well known in the value community and the small cap value community particularly, but perhaps not so much to the broader community. Rather than me give you an introduction, why don't you tell us in your own words how you became Hudson Capital 215?
Hudson 215 Capital. Sure.
Is the small cap value community in the room with us, Toby?
Yeah, I'm all.
It's in the room. It's in the corner over there. Yeah, absolutely. Well, let me just give a little bit of background about myself. And I was involved in a small family business from 1996 to 2022. Started to focus 100% on investing. We have a family office, the Hudson 215 Capital. I've been investing since my early 20s, and it's been fun turning 5 figures into 6, then 7, then 8, and now 9 figures. So guys, I think your audience has probably deeper knowledge of Berkshire Hathaway than any other financial podcast in the developed world. So I think I can reduce my approach to 2 words that every hardcore Warren Buffett fan knows. And those 2 words are salad, oil. I'll say it again, because every hardcore Buffett, I heard the little nod there, so you know those words, salad, oil. But for every Gen Z listener who hasn't memorized all the old school Warren Buffett stories, okay, what was the salad oil scandal? So back in 1963, American Express had an asset lending operation, right, that made a large loan to Allied Crude Vegetable Oil Refining, backed by tanks of vegetable oil. Unfortunately, Allied deceived American Express and others by filling those tanks primarily with salt water and a thin layer of veggie oil on top, right? So when the scandal broke, Allied went bankrupt. American Express was hit with claims almost equal to its end-of-year 1963 market capitalization. But Amex's warehouse lending business was incorporated as a separate entity, right? So Buffett conducted great due diligence and made sure that Amex's poor travelers checks and budding credit card operation had not lost the confidence support of retail customers, businesses, and banks, right? It had not. So Buffett's partnership bought 5% of American Express as a felon reaction to the scandal. Yeah, salad oil investing, or as I sometimes put it, like non-operational turnaround investing, is like buying like a publicly traded stock when the valuation is being hit or held back by something outside its core business operations, right? I've done it with Expel in 2016 because of the 3M patent lawsuit. I've done it with alternative asset managers in 2013 and later, actually, when their K1 partnership structures kept valuations low. I've done it with CME and MasterCard, which were far from profit maximizing prior to IPOing because of their cooperative ownership structures. But I think that there are 2 other lessons, I think, from the Amex salad oil scandal, which I think are crucial for fundamental investors. First, value investing to me isn't necessarily low PE or like low price to book or low price to cash flow. I mean, I've read that like Buffett bought his Amex stake in 64 between $35 and $38, but also read that his Amex position was bought, let's say, closer to $41 per share. So like Amex reported $2.52 in earnings in 1963. Before the salad oil scandal, the stock was trading around $63. Like even at Buffett's purchase price, Amex was trading like in line with the S&P 500 at the time. Second, should you be a value investor or a growth investor? I think the best opportunities tell you the answer. Value or growth? I think the answer is yes. Again, consider American Express when Buffett bought it in 1964. Travelers checks and money orders were its top 2 segments. But you've got this amazing young credit card operations too. And actually, I just want to read you a few lines from the 1964 Amex annual report about the credit card operation, because I think they're hilarious. If you geek out on on investing. For the American Express credit card, 1964 was a year of unprecedented growth. Billings total 344 million, a remarkable 42% increase over 242 million billed in 1963. Total number of cards in force at the year end increased 20%. And this is the money line, right? These increases were the largest of the last 5 years, strengthening our conviction that the market for this comprehensive credit instrument is far from saturated, right? In 1964. It's just hilarious. So, to me, like when you get these rare opportunities, combining like value and growth, as I experienced with Expel, you have to take advantage, right? You have to follow the Buffett line, be greedy when others are fearful. Now, may I use just like a few performance figures, my younger son's UTMA, to illustrate the aforementioned points, right? I'm using his account record because it's a bit less concentrated, more conservative, and the cash flows are, frankly, just easier to track. I'm not going to refer to the real dollar amounts, but I'll use like real percentages and ratios, right? We put $1 in mid 2006, $1 each in January 2007, in 2008, and 50 cents in January 2009. So $3.50 invested in 4 different calendar years. Okay, in the S&P, dividends reinvested, that 350 turns into about $23.65 as of the end of like June of this year, right? No taxes, ETF management fees, or withdrawals apply, right? The 2006, 2007, 2008, dollar CAGR in the tens or so. That lucky 50 cents invested in early 2009 earned about 14.6% through June in the S&P 500. Now, my son's portfolio turned that 350 into $70 at the end of June, right? That's about a 17.5% CAGR. By the way, that's with all the dividends and realized capital gains taxes paid out of the account, right? Also, because we wanted him to have some skin in the game, we withdrew some of his UTMA money to pay for part of his private high school education. So it's really not apples to apples with the S&P 500. But there's one hitch. Those returns are based on the premise that his Expel investment went to zero, right? That did not happen. So include those Expel returns or the returns of positions purchased with his after-tax Expel proceeds, and the portfolio turned $350 into $130. So that's about a 21.7 CAGR net of tax, realized gains, despite some tuition withdrawals from mid-2006 to June 2025. I think it's a pretty solid job. Now, this is the portfolio that holds Expel, but it also holds Blackstone, Apollo, Ares, the alts, MasterCard, which we bought in 2006, Visa, which we bought in 2010, CME, ICE from 2008, and some microcaps and small caps like a company called Hype and Theon and Nordrest, and a few other microcaps and small caps I just can't disclose today. So I think this is like a solid oil investing portfolio, and I think it can be applied to all sorts of assets. For my son's UTMA, my goal was an 80-20 result. 80% of investments should outperform the S&P 500. So this was like a later entry, lower risk, but also like lower reward approach. So I'll pause there. I certainly want to talk about why I like microcaps and small caps, and also why I see the opportunity set going forward, at least for me, which makes my historical returns difficult to replicate. But I can go on and talk about microcaps, or we can pause and see maybe where some of your listeners are handling from today, Toby.
I thought the 80-20 was 80% of the portfolio has to do better than 20% IRR.
Yeah, it kind of maybe historically worked out that way, but I just want to put a little context. I know there's so many like professional investors come on and they can't talk about their records. I just have my own just family money, so I thought maybe just put out there at least one account, give people a little bit of context. Also to show that sometimes like the difference between 17 and 21, I mean, it's just a few percentage points, but over time, it really adds up to the difference between like $70 and like $130. It's a dramatic difference. But happy to go talk about microcaps and small caps if you don't mind.
Jason, let's just talk about, so Amex was going through a crisis not related to its main business. It was the secondary business where they were issuing warehouse receipts for oil that they supposedly had stored in their warehouses. Meanwhile, they've got this credit card franchise, and the question for Buffett is, are people still accepting the credit cards? Because now there's this credit risk that the vendor doesn't get paid, and so they're like, do we continue to accept this or not? He goes and sits in restaurants and discovers that people, are basically completely oblivious to this thing going on, and so he thinks it's a pretty good bet. My question is for Expel. So Expel is a slightly different situation where it's a newer business. They have similar sort of crisis, but more directly related to their core business. So how did you think through the Expel issue and the crisis, and how can you just talk to us a little bit about Expel?
Yeah, I think we could talk about Expel. What I can say is that I was very fortunate to team up with another investor, Lock, Stock, and Barrel, who was also a Microcap Club member, who was also a patent attorney. And in my business life, I submitted my first U.S. utility patent application at age 21. And I've sued and been sued for patent infringement. So we made a good team. And by the way, I always say Lock, Stock, and Barrel deserves the lion's share of the credit for Expel. So what we did to try and understand the situation better, we bought samples of Expel paint protection film after 3M sued Expel. We sent it out to a laboratory to be deconstructed, determined that Expel's film did not violate 3M's patents, and further determined, through our own analysis, that 3M's patent, paint protection film patents were very weak. So, for those two things, determining that 3M's patents were very weak, and also determining that 3M's patents, that Expel's film did not violate 3M's patents, gave us a lot of confidence. Now, 3M is a giant, right? Expel was a tiny company. So there's always the potential that even if you have all the facts on your side, things can go wrong, right? And as you probably know, Buffett sized the Amex position, I think, around 18% or so of his Buffett partnership. And honestly, I did the same thing with Amex. I sized it about 18% of my assets at the time. But I could tell you that after I received that chemical analysis report in mid-April 2016, I really stepped up my purchase of Expel shares the day I received that report, right? So from April 13, 2016 through November 25, 2016, I personally purchased 40% of the Expel shares that traded on its primary exchange, the venture exchange up in Canada. Now, that sounds like a lot, but 40% of 1,600,000 shares is still not that many shares. And those 1,656,795 shares that traded over 7 months or so, that only added up to $1.8 million, right?
Yeah.
So again, we talk about
Yeah.
microcap opportunity and illiquidity. There's so many people they love the Expel story, right? They love the maybe they dream, I wish I had Expel. The opportunity was there, but it wasn't huge, right? Now, in the first, when the lawsuit went public in December 30th, 2015, through the end of 2016, there were 4.4 million shares that traded. But in the first 10 trading days, 1.4 million shares traded. But they were purchased so quickly after the lawsuit. Is that really investing, or is that speculation in paint protection film sardines, really, at that point?
Mm-hmm.
So, and one other thing that I think people forget is that, it was very fortunate for me that and for Lock, Stock, Barrel, that in mid-2015, there was a bear market for microcaps, particularly up in Canada. And Expel had disappointed unofficial guidance in late 2015, right before the lawsuit. So in 2015, Expel was trading above about $33 before the misguidance and microcap recession and lawsuit, right? Nothing would be wrong with 11 or 12 bagger, right, to the current price, but it's not the same as the 30 or 40 or 50 bagger I have on my remaining shares, even at the current Expel price, because of that collapse, right? Which gets us back to the importance, but I think every value investor knows, of purchase price, right? Purchase price is so important, even over a longer time period.
So Jason, how then, I'm trying to think of a scenario where, how do you get comfortable with the potential existential risk? That salad oil he knew the business was still good, but what if there had been, and you knew that it was kind of bulkheaded based on the corporate structure, but I'm thinking about like maybe would be good, like AIG, for instance, in 2008. You have a very good insurance business, but you have this kind of derivatives trading arm that ended up kind of bringing the whole thing down. Um, how do you kind of separate what's actually an existential crisis, like could kill the company, and what is sort of more headlines and other over and above just, I guess, due diligence and then position sizing, like for the managing that risk?
I'm going to give you sort of like an odd answer, and it's sort of tied to the it's tied to the numbers when I broke out Expel, let's say for my son's UTMA and like the non-Expel, like saying like, okay, what would happen if it went to zero? I think ironically enough, like if you people know if they're a pretty good investor, and and even if it went to zero, okay, I felt that I still could compound money at a very good rate. And I wasn't putting in like 60 or 70 or 80%. I'm not one of these like young Turks who just could put in, 90% in there and
YOLO.
And YOLO, right? I was in my it was the late 30s or early 40s, build up some assets. I can't play Candyland or whatever and go back to or shoot some ladders and go all the way back to the bottom anymore. No, I can't do that. Right. I think, honestly, Jake, I don't know if, that's why you size things, right? In some ways, right? There's no way of like handling all the risks. And everybody knows like a level of concentration they're comfortable with. And I will say, there's a difference between, I think, sizing it at cost, like I did, and also just letting it run after some of these things were resolved, into a much larger position. But I don't have a great answer for you, Jake.
I think that's a pretty good answer. I like that. I like that approach to its sizing. Helps you deal with that sort of risk. Talk to us a little bit about microcaps. What's the attraction there?
What's the attraction there? that's the question that every.
I run a microcap fund too, guys. Just
yeah, I understand.
Yeah.
So yeah. Yeah.
So I'm really asking you, like, why should
what's the attraction there? Well, just sitting there, like, what is the attraction? Let me come up with something here. Damn it!
Help me out.
Yeah.
Help me out. Right. Let me do the when in doubt, always Charlie Munger something. Right. So let me invert the question.
I love it.
And say what hasn't changed in the microcap world over the past 10 years, and then I'll talk a little bit about what has changed in the microcap world according to me.
That's even better.
So I think the microcap world. I think particularly in the United States and Canada, still resembles Thomas Hobbes's like famous line, like nasty, brutish, and short, right?
Yeah.
So here's some simple data that like I just from a screening and data tool that we use, like Portfolio 123. For the last fiscal year, I think there are about maybe 361 out of 500 S&P 500 companies that generated a return on equity of 10% or better. For microcaps between 10 and 400 million US dollars. Market capitalizations with their primary exchange in the USA or Canada, only 526 out of like 3,154 generated an ROE of 10% or more. So that's like 16.6% of companies. And frankly, those figures make microcaps look good. There are 29 S&P 500 companies with negative common equity, but generated like positive net income. So you'll find companies like AutoZone or Lowe's among them, right? That
tons of buybacks.
So much common stock over the years, the shareholder equity is negative and their ROE is basically infinite, right? Plus there's companies like Pfizer, which maybe they earned a little bit less than a 10% ROE in 2024, but because of like sizable goodwill and intangibles on their balance sheet. Now, among the 526 USA and Canadian microcaps with an ROE of above 10, you'll find 55 names with a positive ROE and a negative common equity. They're like, these are not AutoZones, right? They're not AutoZones. You're seeing like a perennially money-losing company with negative shareholder equity, with like 1 year of positive accounting profit. For example, there's like Victor Mining Group with a $50 million market cap and made $101,000 in net income in 2024 after years of losses, and has a negative shareholder equity of like negative 1.2 million, right? And for the record, I do not own any shares like Victor Mining Industry Group. Like, so please don't go out there and say like, A-Track likes it. No. Okay. So, by the way, the ROE figures are not much improved from the larger microcaps. But to be fair, these figures are using reported earnings, which may or may not be helpful for some microcaps and small caps, and we'll talk about that a little later. So the ROEs aren't great. And what's also challenging is persistence, right? Even back then or now, a lot of microcaps disappoint a good percentage of their investors who, quite frankly, expected more and faster than what they're receiving, right? So, and Ian has talked about this too a little bit. Like microcaps often string together a few quarters of top line growth, a few quarters of operating margin improvement. They race ahead, they hit the next pothole, and they bend an alloy wheel, and there they sit, right? So they're very well suited for 6 months to 2-year holding periods. And to be fair, at the right price, right, you can make good money buying a money-losing unknown company that graduates to break even or profit mediocrity, right? You can make 3, 5, 10 times your money in some cases buying something that turns into like a 10% ROE company. But to make that 10 times, I think you really probably had to exit when expectations were greater than a long-term 10% ROE biz, right? You're taking advantage of that over-exuberant expectation. I think in some ways, like the fact like many USA and Canadian microcaps are so poorly suited for like longer term investors, so often given to like fits and starts, so little populated with like long-term winners, this actually creates an opportunity for like investors like me, right? The greatest returning microcaps over the long haul are rarely owned by those who like originally owned their shares, because it takes a different set of skills to know which microcap is like worth suffering for. So I think, what has changed? So microcaps are particularly well suited, I think, for the investing Substack phenomenon, right? Everybody loves to read about a new name, right? And there's so many like new to you names in the microcap space. And you combine Substacks with like ChatGPT, and it's easier than ever to do like research and publish like respectable articles about microcaps like one after another. I think there's also like another push-pull dynamic. Like more attention, like additional investors chasing after the same name, potentially pushing up prices is not normally associated with higher long-term returns. But the microcap space is not the large cap space, right? Microcaps in USA and Canada, particularly Canada as a group, are like net share issuers. So higher share prices could actually lead to lower levels of equity dilution for like every dollar raised. Like it actually lowers the cost of capital for microcaps. So, and I'm just saying this is potential. The microcap community could see both higher share prices and more volume because of the Substack phenomenon. And a higher average daily volume also could open more names like more hedge funds, right? So I think that potentially we could see like a Soros style like reflexivity loop that helps microcaps. Perception shaping reality, which shapes perception, and so on. So
right,
that's how I see.
Like lowering the cost of a good write-up, then kind of puts more companies on the potential menu of investors. Yes.
So I think the Substack and I think in AI are really changing things. And honestly, I think if you don't mind, where is it here? Yes. And the high tech technology here, right? We got this chart here, which I think we've all seen, but I'll just describe, right? It's the Torsten Slok chart highlighting the 40% of Russell 2000 companies that reported negative trailing 12 months earnings. We all know it. If you're a value guy looking for evidence of an overvalued market, like maybe someone here, right? Or if you're a small cap investor like myself, like you've seen that chart, that chart, you think about it before you go to bed at night. So earlier, I highlighted some of the like 10% ROE threshold figures for microcaps in like the S&P 500. But I also like hinted maybe it's not as much meaning as it may seem. So I want to give credit to like Alger Asset Management for publishing an article about what I believe is like the most important academic paper for small cap and microcap investors in many years. And this paper has a really sexy title: Reassessed earnings with capitalized intangibles, right? Now, we all know that the percentage of company investment in intangibles versus tangibles has been growing dramatically these past decades, right? GAAP treats tangibles and intangible investments very differently, right? Expensing typically versus capitalizing in many cases. Now, this wonderfully named academic paper, what it does, it capitalizes intangible investments and rightly offsets a portion of the advertising past intangible spending. So the net effect is earnings as a percentage of revenue improves 900 bips. The effect is magnified for the small quartile stocks in the study, a 2,200 bips improvement.
Wow.
So what that means is nearly 60% of the smallest quartile are reclassified as profitable from unprofitable, thanks to capitalizing intangibles. And what's also interesting to know, at least to me, is that the stock market performance of those gap losers but capitalized profitable firms produces returns 1,600 basis points higher than the overall universe in the study. So, and plus, since they reclassify intangibles, they shift them to the investing section out of the investing section of the cash flow statement. Yeah, out of the from the operating, it also changes the operating cash flow to look much more impressive. So, what I think what we have here is in the near future, I think AI tools are going to allow investors to much more easily manipulate GAAP financial statements to unlock more accurate economic earnings. And this is what microcap and small cap have historically lacked, right? Which is being like remedied by AI and Substacks, right? They need effective but affordable tools to identify tiny stock opportunities and broadcast them to a wider audience. So I think that's really what is changing in the microcap world, right? Before, quality stock coverage was something only the big boy firms covering big boy stocks could manage. So to me, this is like the biggest difference in the last 5 to 10 years for the microcap community. Of course, the big risk is like illiquidity and cheap tools also attract charlatans of all sorts, right? So we're gonna have to see how this plays out.
Yeah, there's the amount of noise that can be created is going to just go off the charts.
Yes, right. And you already see this because human nature doesn't change, right, Jake? I mean, all the tools can change, and there's always going to be a desire for, someone who promises, tremendous returns in a short period of time, right? And if that attracts more eyeballs, if that attracts more subscriptions, then garbage in, garbage out.
Yeah, or you
Right.
could could camp outside Drake's house with a whiteboard too. I saw that. That seems to to buy some.
Right? I mean, there was some like Twitter investor who like wrote a like thread about me just like a few days ago, who like characterized my Expel investment as like a 1,000 bagger, right? And I corrected him. I said, no, it's not that. But nobody reads like
950
down there, right?
at the most, guy. So.
Exactly. And it's like, I always thought that, I mean, and I'm getting all this attention. I didn't even have to take my clothes off. So it's on one hand, it's like, it's cool and interesting, but sometimes I cringe a little bit because like the important messages are being lost, right? About like risk control, about the importance of prices being paid, diversification at some level. These are all important things, and I started off reading a lot of John Neff, and nobody even knows who John Neff, you guys nod your head, Vanguard Windsor, at one point the largest fund in the country. Nobody cares about these guys anymore, right?
Mm-hmm.
Just the three of us and about probably 1/4 of your listeners.
Jason, we usually do at the top of the hour some veggies from Jake. I'm just going to do I'll do a quick shout out to all the folks at home. Tallahassee, what's up? Petah Tikva, Israel, Max in Valparaiso, how's it? Cleveland, Lausanne, Switzerland, Bethesda, Brandon, Mississippi, Lewis, Delaware, thanks for spelling it out for me. Bremerton, Boise, Houston, Jupiter, Florida. Good on you, Sam. You've already won there. Bellevue, Nashville, Toronto, Snohomish, Nashville, Temecula, Sardinia, Italy, Katowice, Poland. Hopefully I'm saying these correctly.
There's always a first time.
There is. So
AI Toby's going to pronounce them all correctly in about 3 years.
God, wouldn't that be great? I'll hit the beach. New London, Minnesota. Last one. All right, JT, hit us with the vegetables.
All right. Well, knowing that Jason was coming on and that he has a reputation that is perhaps not always as deserved as he was just saying, as far as like being this microcap only kind of investor. And I knew that that wasn't totally true either. But I wanted to focus on something in the smalls kind of category of potential veggies, maybe more like peas or something. But let me set the scene. We're underwater at a coral reef, and sharks are cruising by like these shadowy submarines, and parrotfish are grazing leisurely on coral, and a panoply of fish are just swimming around in this mesmerizing chaos of color and motion. And then something quite strange happens. A shark slows down and hovers, and then it opens its mouth, and into the mouth swims this tiny fish, and it's called a cleaner wrasse, Wrasse. And this bold little thing wiggles in and starts nibbling parasites off the shark's gums and gills. And the shark doesn't chomp down on it. It just waits patiently, almost like it had booked a dental appointment. And what in the evolutionary world is going on here? And before we untangle that, we will give you some fun facts about cleaner wrasses. They're what's known as sequential hermaphrodites, meaning most of them are born female, but if the dominant male disappears for whatever reason, the biggest female in the group will literally change sex and take his role. So they're bringing a whole new meaning to the term next man up. The cleaner wrasses also punch way above their weight in cognition. Experiments suggest they can recognize themselves in mirrors, which is a sign of self-awareness that's quite rare in animals. Evolution gave them this sharper social intelligence because their livelihood really depends on reputation and trust. And there might even be clues in our own intelligence about, our minds being sharpened by the demands of being so social. Like we had to figure out who was trying to trick us and who wasn't, and who, coming up with good ways to trick each other. Young wrasses learn how to clean by watching the adults. So they even start with practice clients, like smaller, less dangerous fish, before moving on to sharks and groupers. So there's actually like cultural transmission, like skills passed down, not just encoded in DNA like most animals. So it's like this apprenticeship reef style. So as you know, like nature is very rarely this feel-good story. It's red in tooth and claw. And so why does an apex predator like a shark, capable of obliterating this little wrasse in a nanosecond, suppress its instinct to chomp down? And it's because that tiny fish is quite useful. It's indispensable even. And it's been performing these functions for millions of years, generation after generation. And the wrasse offers a service the shark can't perform itself with its parasite removal. And without them, these parasites spread, the fish populations weaken, the whole reef might get sicker and even collapse. So you wouldn't think it, but this quiet mutualism is a pillar of the ecosystem's resilience. And now let's attempt to torture this analogy into place.
This is the best part.
Yeah. We'll see. So, replace sharks with Fortune 500 companies and replace the wrasse with these microcap businesses. So these tiny companies, they don't necessarily try to beat the sharks. They're too small. They know that. They could never outmuscle Amazon or Tesla, but instead they find their niche, tiny but vital role, and a cleaning station kind of in an economic reef. And just like the wrasses, they survive by being indispensable. So let's maintain a little bit of sobriety here. Like many microcaps are landmines. They overpromise, underdeliver. Some are penny stock casino chips or zombie businesses kept alive by dilution. And some are the investing equivalent of a false cleaner fish, which is apparently the species that mimics the wrasse and in look and behavior, but then it sneaks in and it starts like biting off the scales of the fish it's supposed to be servicing. So it impersonates the real business value to get that kind of quick hit. And I think you probably see that a fair amount. So yes, due diligence critical. And most microcaps will never grow into these giants, but that's not really the point. Like what we might seek is those whose utility to the shark is so high, it becomes symbiotic fixture in the environment. And just because a firm is small doesn't mean it's not significant. Small businesses make up 99.9% of the U.S. businesses. It's a very long tail. And they employ nearly half of America's workforce. They are the reef. And small, mid-sized enterprises, defined as firms with fewer than 500 employees, produce around 44% of U.S. output. So almost half the economy. So the Fortune 500 companies dominate stock indexes, but the real scaffolding of America's economy is built on millions of small firms. So they're kind of the connective tissue that kind of keep the sharks healthy, to be honest. And what's equally striking is how dynamic these small firms are. Since 2020, amid pandemics, inflation, supply chain shocks, they've created 2.6 million net new jobs, and much of this coming from these younger firms that are less than 5 years old. So the cleaner Wrasses remind us that survival is not just about being big; it's about being indispensable, and that can mean you can be indispensable at any size. So it's finding your niche, embedding, delivering steady, reliable value. And microcaps that embody this kind of model, they may not scale to the moon, but they can certainly endure and be great long-term businesses to own. So, in investing, everyone is chasing scale, especially these days. And they want that next giant, that next shark. But sometimes the best returns can come from spotting the Wrasses in the world, these tiny firms with niches so vital that the ecosystem sort of bends around them. And survival isn't always about size. It's really also about that indispensability.
Good returns from cleaner Wrasses.
Wrasses. Yeah, I think I'm the evolution of that to the microcap investors. We went from Wrasse to dumbass, but when we're out there, we're making it.
I think that was sperm whale worthy, JT.
Was it? Okay, good.
Yeah, I think there's going to be.
That was a good one. I like that one.
We might want to hear more about cleaner Wrasses in the future.
Well, I've given 125% of my knowledge base about cleaner Wrasses at this point.
That's it. You're all out of Wrasse. Okay.
Yeah. Jason, do you think if there's a lot of attention brought on small and microcap in the way that you're suggesting with like ChatGPT and Substacks, that some of the return goes away? I mean, if you're demonstrably able to like sift through and identify the nuggets of gold in there, does that bother you?
I think over time it does. I think there's always a challenge, right? I mean, the offset is thanks to interactive brokers, thanks to Zoom, thanks to the same tools. Microcap investing has turned from a USA, and Canada to really a worldwide search, right? Our net is much larger. We're looking at Swedish and Polish and tiny Japanese Wrasses, right? And I think that is perhaps the offset. You always want somebody, any investor in somebody's is always a difference. There's always a struggle. Like, wait, what things don't you change and what do you change? Yeah. And Munger has talked about this, like what ponds do you want to fish in, right? Trying to bring us back to the sort of a sea analogy here. So we're finding that a lot more in like looking at opportunities in Europe and even in Japan, right? If you told me 20 years ago that I would be like spending part of my time in 2025 studying the Japanese divorce market, I would have laughed, right? But what I found, like with some age and some wisdom, is that what makes people laugh today sometimes can make them cry tomorrow, because that's the opportunity they missed. Yeah. Right. Particularly in the microcaps, you end up with these weird little niches, and it's very fascinating. That's half the fun of being a microcap investor, going down these rabbit holes and doing a lot of research.
What do you think of the opportunity in Japan?
Japan, I have to admit, I was very cynical about Japan for many years, and this is actually one of the downsides of experience. Right, I've seen so many times when these promises of like Japanese, they're going to, this is the time Japan really gets their act in gear, right? And it's like, forget about it, right? And so for a long time, I just avoided it, and I still think there's a lot of opportunities in looking for. Something that trades at a 14 PE, but an EBITDA of like 2, because they have all this cash in the balance sheet, and there'll be some process by which they get cash back. But honestly, what we're doing, we're focusing on is thinking about, okay, what's the next step? Okay, once these value opportunities start to go away, once the average valuation goes up, I think there's actually a number of microcap and small cap really good businesses which are just not being paid attention to, right? Maybe they trade at a 13 times PE or 11 times EV/EBITDA, which every foreigner in Japan says, why should I pay for that when I get something at 3?
Yeah.
But they really should be trading because they have such great opportunities ahead of them and they're growing so quickly and their return on invested capital is so high. They should be trading at much higher rates. And there's an opportunity there for like a very long run. And that's really like our game, right? So it comes back to like, okay, where can I apply my skill set? Where in the world can I apply my skill set? And now I'm starting to see opportunities in Japan. And that's probably because of like, again, these chat GPT type tools. Like I could translate things and get much more effectively and get much more information in English than I used to. And then you combine that with like expert interviews. And then, okay, now maybe we can play in that market a little bit.
Do you have any view on that effort by the exchange in Japan to, there's trying to get their stock price above book value? There's some penalty for not doing that, or some social stigmatism for not doing that, but no other.
I've seen, I think it seems to be working. I'm not an expert in that. I've seen like there may be one reference to like some company that gave maybe a dividend not based on market capital, but based on a percentage of their book value. And since the book value was so much greater than the market cap, like it immediately like moved the stock up. And so I think I think that's finally starting to get resolved, which is I think is interesting. But again, it's not really the area that we're like really playing in. We're fascinated with Japanese divorces here at Hudson 215 Capital, right?
What can you tell us about Japanese divorces without?
Well, I can tell you about Japanese divorces is that again sometimes what's going on in Japan is that there was a loosening of. It used to be very, very difficult to become an attorney, extremely difficult. And then they loosened the standards some because it was just too difficult. And this is like maybe like 10, 15 years ago. And so there was a growth in the number of attorneys, right? At the same time,
that's when it all went downhill.
At the same time, you also have like Japan is aging, right? And you have divorces, which like very simple divorces, you don't even need lawyers in Japan. But there's more complex divorces that are occurring because people are getting divorced also at a later age. There's much more like people getting divorced at age 40 or 50 or even 60, right? Where now you have to really split assets. There's sometimes children involved. And so in essence, you also now need attorneys are competing for like divorce clients. And so that's creating an opportunity for basically websites which are just collecting like basically a collection of divorce attorneys that people who are looking for a divorce go on to and hook, they hopefully get hooked up with a particular attorney. So again, it's a weird little niche. But these and it's not just divorce attorneys, it's also other attorneys too. But the divorce attorneys seem to be one of them because a corporate attorney, like a leading part, because a corporate attorney sometimes you have reputation, right? And the attorney therefore doesn't need to like advertise to get new clients. Divorce attorneys, there's more advertising necessary, right? It's not 16. You don't have like 16 friends who all got getting divorced or have gotten divorced recently. You may not even want to talk about it with any of your friends yet. Right, so you try and use like search engines and something like that a little bit more. So we get back to these tiny little weird markets, right, which are opportunity, and that's my bread and butter.
Are you sort of looking outside of the US because you think the US is picked over or expensive, or is there any reason for that?
Well, when you get back to it, right? I mean, the challenge is like we put in, let's say, 1.8 million into Expel, right? And that was less than 20% of our assets at the time. Well, if I want to put the same amount if I put the same amount of money into something, that's like less than 2%, right? So Expel was a magic unicorn, right? How do you find 20 magic unicorns or 10 magic unicorns? And really the answer is you don't. And I think there's a temptation when you win the Super Bowl, right? You want to get back to the Super Bowl, right? You love that feeling of like winning the Super Bowl. But there's so many dynasties of one or dynasties of two, right? Because all these competing human emotions and greed and people, the desire for credit comes into play. So, I really don't want to have to move to look at larger companies, but I do need more opportunities, right? So that's a reason to go abroad. And frankly, there's just more profitable businesses abroad than there are here at the microcap space or the sub 100 million, market cap space. So, it's the old Peter Lynch line, like, how do you go out of business, right? When you run out of cash, right? I do not want to like invest, a lot of money into a US money losing microcap where it's going to take me 2 months to get out, right? And so you're like the obese fat man trying to squeeze your way through like a very narrow window in order to get out, right? It's not going to be pretty, and you're going to get scratched up to hell, right? So I have to look abroad, and frankly, why not use the advantages of size, to help me, right? One of the things that I learned as a small businessman, because we were like a small, 7-figure revenue business. Our large customer, fairly concentrated, was like a multi-billion-dollar entity, right? So there are like so many little things you have to do, and we somehow found a way to increase like gross margins from like mid-30s to like low 50s, right? Technically, they should be squeezing us, right? It all comes down to like creativity, like 10, 15, 20 little things that you try and put together, like to create opportunity. So my kids are older, right? I'm a 50-year-old, like I'm dyeing my beard. Toby may need to dye his beard, but it's not doing it. So why not get a place in Europe that I can use as base operations, right? Visiting companies is so important to me, so important to my style, right? I can go there, I can spend time there, I can just, if as a US investor, if you're here and you want to visit, Europe, you gotta want to visit 6 companies, 7 companies, you gotta do like 3 months in advance, try and schedule it all together. No, I could be, in Europe and, just do things a little easier, a little quicker, hopefully find that company a little sooner, right? And that's what occurred with a company called Hype, which is a nicotine pouch distributor, right? We were one of the first outside investors to go. We walk in, the lobby has a ping pong table, right? And you're like, this is a tech company. This just happens to be nicotine. This is not really a nicotine business, right? There was another, and this is an odd one, okay? Another CEO in Europe sitting across them at a conference table, like basically diagonally. And this guy was answering our question, and he was like so immersed in answering the question. But while he was like answering the question, he didn't know what else was going on. He was like so immersed in giving the answer. Takes off his shoe, takes off his sock, starts like picking at his toes, like little toe flecks, or like just like landing on me. And like, on Zoom, you don't get this, right? But like you want a
Thank God.
immersed toe fleck CEO. Some guy's like so focused on the business, he doesn't realize like little like toe jam and toe fleck is like going off into the world. And and I hate to say it because that toe jam investment is like a multi-bagger, right? So
Put that on your checklist, everybody.
Put it on the checklist, right? So unfortunately now there's gonna be some CEO who like goes to like the Microcap Club conference and now takes off his his shoe and does the same thing just to project that, right? So it only can be used one time.
Jason, what do you think about the argument that there's been this gradual worsening of the microcap opportunity because either there just haven't been as many coming in because either Sarbanes-Oxley or their companies are held privately for longer, so they go public when they're bigger, or private equity is picking out the good ideas from that. Have you seen that in practice?
I think it's worse and always getting worsener. Look, I mean, I think we all know that line, and I do see some examples in Canada, which I think are very disturbing in some ways. That like microcap companies, they've done a few raises, they're finally breaking even, finally going to be hopefully going on that finally exponential, and then PE comes in, takes them out. Management gets a good piece of the action too, right? And meanwhile, small investors like us are in essence the bag holders funding this company through the losses, and the PE firm is going to get the gains. So I think that is a risk, that is a reality. It's a reason why I go into like Sweden, which I think you need like 90% of like shareholders to agree in order to be taken out. And I think that's very advantageous to say, for investors like myself overall. But I think I agree with you, or I agree with the premise that that's a problem, right? And hopefully what you do is you offset it by going internationally.
Do you feel like there are other countries around the world that you feel comfortable as an outside shareholder in Japan and Sweden or Switzerland?
Sweden in particular, I think Sweden actually has a large number of individual companies, which I think are small but profit making. I think Sweden, you have a lot of CEOs who speak English. You also have a lot of CEOs tend to be very, I hate to say it, a little more honest in some ways than American microcap CEOs who tend to be a little bit too PT Barnum and Bailey,
Yeah.
kind of attitudes. I was talking to like a Swedish CEO maybe a couple of years ago, and they had a new product, and they're just like the first installation in a garage, in a garage renovation, a commercial garage renovation. It's like, so how's it going? He's like, it's going terrible. We've really screwed up. Sometimes you don't get that kind of honesty with American microcap CEOs. So I think there's a lot of foreign CEOs. And I also did make another statement here. I think American management teams, compared to the price you see for like foreign management teams, I think we're in some ways grossly overpaid at the microcap small cap level. And that's probably because of the pay level of the large caps and the way it just oozes up. And so what you end up seeing, therefore, is sometimes a lot more equity dilution, whether just from the need for a secondary sooner or just from more stock options or restricted stock given to management, which, you start diluting things to 3 or 4% a year, and now you're turning a stock into an equity option, right? Timing really matters. And I really don't want to invest in a situation where I got to be right by 3 Tuesdays from now.
Yeah, especially if you're carving out 4% a year, and it seems like they're not delivering on the operational results. You're like, why do you get this?
Yeah, and then you watch yourself. The way you lower your percentage of ownership is by getting diluted away, right? Which is not exactly what you want. So microcaps have always been like, not always, but it's like an outlier situation, right? You can invest, throw 10 darts at S&P 500 companies, throw another 10 darts every year, rebalance, and you're probably going to retire okay. You do that in the microcap community, you throw 10 darts at any microcap stocks, rebalance, and next year.
Would you like fries with that?
Yes, and now you're a Walmart greeter, right? At age 60, and not even at age 65, right? Because you can start at 25. You'll need to be a Walmart greeter by age 29 because you'll be like bankrupt in like 4 years.
Yeah.
What are some red flags for microcap investors while we're speaking about short paths to back to work? Yeah.
Let's see.
What do you really dislike? Too much equity issuance. Too much.
Obviously, too much equity issuance. I prefer a smaller TAM, right, and maybe possibly dominating a smaller TAM rather than the
1% of
Chinese math. Chinese math PowerPoint that says we get 0.2% of this gigantic market, right? We're going to be 17 times larger than we are today, right? And for some reason, the IR guys, they constantly like push those kinds of presentations out. You think they would have learned, but no.
Any other red flags?
Oh, I mean,
from experience, maybe.
From experience, I think the one of the maybe what I have not paid as much attention to in the past as I should have. It's like the importance of a board, a decent board to a microcap, or at least not a bad board to a microcap. I
every company
did not.
Really.
Yeah, every company, but these, especially these tiny micro caps, right? The CEO has so much on their plate, and they really, they don't need another distraction, or they need some help. And so the board really is, can really be either a positive or negative, like like
Yeah.
magnifying element.
I mean,
And
when it's a low mass and therefore inertia is low, and any force acting on it is going to have more impact than typical.
right, absolutely. And you see a lot of these sometimes these boards, like they try and like microcaps, like they try and attract like big name experienced people on the board from like very large companies who have like no idea what it's like running like a little microcap, right? Because when you can't hand things off to like your assistant who hands it off
Yeah.
to their assistant who hands it off to their assistant, right? And I think that's the thing. I also like to talk to not just the CEO, but at least the CFO or some other people in the in a microcap, because I find that a lot of times you get a CEO who's very, very competent. The question is, can they build a team around that? Right? In some ways, you have to scale. When I started off microcaps, I have to. I honestly, I started at first was more attracted to like high gross margin microcaps. And I've now turned to more like low gross margin microcaps. And the reason is, at any given market cap, that low gross margin microcap typically has like more employees. Um, and so what I find is like seeing a company like, okay, at a $80 million market cap, if you have like 100 or 60 employees versus like a team of like 12, the 60 employee one, you can see whether the CEO knows how to scale in terms of hiring, right? Knows how to delegate a little bit more at a given level of market capitalization. So I've sort of, that's not necessarily true with large caps, when in some ways, maybe you want like a 70 or 80%, super high gross margin SaaS kind of situation, but microcaps are different.
Yeah, the 60 employees looking a little bit more to the future, not sort of necessarily maximizing the returns on their current infrastructure, whereas the smaller one is sort
Yeah,
of getting as much out of it as they possibly
it's
can
smart getting
now.
out there, but you got to see, the point is like, can you get escape velocity, right? That's always what it comes down to, like market caps, micro caps, right? Can this rocket ship actually take off, or is it just going to go on and just come back down to Earth? And so any kind of little clue about escape velocity is priceless.
I have like a hypothesis. I'm curious what you think of this. If I sort of imagine S&P 500 companies as they're probably all sort of like happy families culturally, that they're all the same, whereas the what is it, Tolstoy,
Mm.
and unhappy families are all uniquely unhappy. But like there's probably like higher variance of culture within the microcap community relative to S&P 500, which I kind of feel like might look a lot more homogenous culturally.
Well, you're definitely going to have an S&P 500 CEO who takes off their shoe and socks and like dribbles little toe flex on you, right? I mean that does not occur, um, because they're like great politicians, right? In order to get up to that level, you have to have some political skill. But I think you're right. I think there's certainly, I mean, there's absolutely more variance in microcaps. The challenge is for a lot of young people who get into microcaps, right, to get the lotto mentality. There's a real desire to get off. I'm age 26 and I don't want to work in a job for the rest of my life. I want to be a full-time investor, right? So you end up subconsciously being pulled to like lottery tickets, because this is, in some ways, if one of them pays off, now you're like, I'll be a full-time investor. I mean, I didn't start becoming a full-time investor in my 40s, and everyone just thinks I'm nuts for doing so. But I was working in a family business with my dad for many years, and honestly, I really enjoyed it. I loved working with my dad, and there's something I think to be said for actually making something, not just trading, which is fine. It creates a lot of like value for the market, but producing something for actual customers to use, I think has a lot of this emotional value to me for many
Yeah,
years, and
yeah.
I didn't want to give that up.
Making payroll is like a real, that's a
Yeah, and this
different.
is something to be said, to see an employee hopefully move on. There's something better in their life, and um, So yeah, it was a lot of fun, but in essence, it was time to move on to a new chapter too.
Jason, we're coming up on time. If folks want to follow along with what you're doing or get in touch with you, what's the best way to do that?
Yeah, Toby Carlisle. No, no. I mean, you can find me at A-Track 180 on Twitter. You can find me on Microcap Club under A-Track. You can search for Hudson 250 Capital, world's worst website, and send me a message.
Who's the website even for, Jason?
It's just it's for the problem that I have here, Jake, is that like you reach out to companies and they're used to certain structures,
Okay.
right? So if you say like your family office and you're set up a certain way, and have this website, okay, that somehow it gives you legitimacy.
Gotcha.
That's who it's really set up
Yeah,
for,
it's
just
a
to get
beer,
off
it's
that.
a beer just to get them
It's just a
comfortable.
beer. It's kind of like your mustache to give you a little bit of respectability.
Yeah.
You think that's what it does?
But serves no purpose.
Theoretically. But my website is about as well developed as your mustache. I'll say that.
There you go. I'll take it.
Thanks so much, Jason. Incredible lessons from.
No, I'm really had a lot of fun and really enjoyed it.
We appreciate it. Thank you. JT, any final words?
I got nothing.
Check out Journalytic, folks.
Sure.
Sure. Why not?
We'll be back next week, same bad time, same bad channel. See everybody then.
Thanks, Jason.
Peace.